A historic plunge, the Nikkei 225 index experienced a staggering 12.7% drop. This marks its worst two-day decline since the Black Monday crash of 1987. This dramatic plunge sent shockwaves through global markets. Investors are left grappling with uncertainty and fear. This historic drop is a stark reminder of the interconnectedness of global markets. When one major index experiences such a significant decline, it sends ripples throughout the world. This interconnectedness has been amplified in the digital age where information travels at lightning speed. The speed and severity of the Nikkei's decline have left many investors reeling. Some are questioning whether this is the beginning of a larger market correction. Others are viewing it as a buying opportunity, believing that the market will eventually rebound. The Nikkei's plunge is not an isolated incident. Global markets are experiencing widespread turbulence. The Nasdaq, a key indicator of the tech sector, has also experienced significant losses. This indicates a broader sense of unease among investors. The synchronized decline of major indices points to systemic concerns. Investors are grappling with a complex web of factors. These include rising inflation, geopolitical tensions, and the potential for a global recession. The current market climate is characterized by a high degree of volatility. This makes it difficult for investors to make informed decisions. Many are choosing to sit on the sidelines, waiting for more clarity before making any significant moves. Several factors have contributed to the Nikkei's dramatic decline. One key driver is the U.S. Federal Reserve's aggressive interest rate hikes. These hikes are intended to combat soaring inflation. However, they have also raised fears of a recession. The Fed's rate hikes have had a ripple effect on global markets. They have led to a strengthening of the U.S. dollar. This has made it more expensive for Japanese companies to import goods, putting downward pressure on corporate earnings. Another contributing factor is the recent release of disappointing economic data from the U.S. This has fueled concerns about the health of the global economy. Investors are worried that the U.S., a key driver of global growth, may be heading for a slowdown. Section 4. Tech Titans take a tumble. The technology sector, once a darling of investors, has been hit particularly hard by the recent market turmoil. Tech giants like Apple and Nvidia have seen their stock prices plummet. This reflects growing concerns about the sector's growth prospects. The tech sector's high valuations were largely based on expectations of continued rapid growth. However, rising interest rates and slowing economic growth have led investors to reassess these assumptions. Many are now questioning whether tech companies can sustain their previous levels of profitability. The tech sector is also facing headwinds from supply chain disruptions and increased competition. These challenges are further weighing on investor sentiment. As a result, many are rotating out of tech stocks and into more defensive sectors. Section 5. Powell at the helm, charting the Fed's next move. As the world watches closely, the decisions made by the Federal Reserve under the leadership of Jerome Powell are more critical than ever. All eyes are now on Jerome Powell, the chair of the U.S. Federal Reserve. His every word and action are scrutinized by economists, investors, and policymakers alike. Investors are eagerly awaiting signals about the Fed's future monetary policy decisions. The anticipation is palpable as market participants try to decipher the Fed's next steps. These decisions will have significant implications for global markets. A single announcement can send shockwaves through stock exchanges from New York to Tokyo. Powell is facing a delicate balancing act. He must navigate the complex interplay between economic growth, inflation, and employment. He must weigh the need to control inflation against the risk of pushing the economy into a recession. This is no easy task as the stakes are incredibly high. The Fed's next move will depend on a variety of factors, including upcoming economic data and geopolitical developments. The global economic landscape is ever-changing, and the Fed must remain agile. Some analysts believe that the Fed may need to adopt a more dovish stance in light of the recent market turmoil. This perspective suggests a more cautious approach to avoid further destabilizing the economy. This would involve slowing down the pace of interest rate hikes or even reversing course. Such a move could provide relief to markets but might also signal a lack of confidence in the economic recovery. However, others argue that the Fed must remain committed to fighting inflation, even if it means risking a recession. They believe that controlling inflation is paramount to ensuring long-term economic stability. The history of the Federal Reserve is filled with pivotal moments where decisive action was required. Powell's decisions will undoubtedly be compared to those of his predecessors. As Powell charts the Fed's next move, the world waits with bated breath. The outcome of these decisions will shape the economic landscape for years to come. Whether the Fed opts for a dovish or hawkish stance, the ripple effects will be felt across the globe. Investors, businesses, and everyday citizens will all be impacted by the path the Fed chooses to take. In these uncertain times, the role of the Federal Reserve and its chair has never been more crucial. The world watches, waits, and hopes for a steady hand to guide the economy through these turbulent waters. Section 6. The Bank of Japan's Balancing Act. The Bank of Japan, or BOJ, is also facing a challenging environment. As the central bank of the world's third-largest economy, its decisions have far-reaching implications. Like the Fed, it is grappling with rising inflation. This inflationary trend is not just a domestic issue but part of a global phenomenon affecting many economies. However, the BOJ has maintained an ultra-loose monetary policy for much longer than other major central banks. This approach has been a double-edged sword. The BOJ's policy of yield curve control, which involves keeping interest rates at ultra-low levels, has helped to support Japan's economy in recent years. This policy aims to stimulate economic growth by making borrowing cheaper for businesses and consumers. However, it has also led to a weakening of the Japanese yen. A weaker yen can boost exports by making Japanese goods cheaper abroad, but it also has downsides. This has made it more expensive for Japanese companies to import goods, contributing to inflationary pressures. The cost of essential imports like energy and raw materials has surged, affecting both businesses and consumers. The BOJ is now under pressure to normalize its monetary policy. Policymakers are in a tight spot, needing to balance the risks of inflation with the need to support economic growth. However, doing so too quickly could risk derailing Japan's fragile economic recovery. The economy is still recovering from the impacts of the COVID-19 pandemic, and abrupt changes could lead to instability. The BOJ must carefully calibrate its policy decisions to avoid further shocks to the global financial system. Its actions are closely watched by global markets, and any misstep could have international repercussions. The central bank's policies also have a direct impact on everyday life in Japan. From the cost of groceries to the interest rates on loans, the BOJ's decisions affect all aspects of the economy. As the BOJ navigates these complex challenges, its balancing act will be crucial not just for Japan, but for the global economy. The world is watching to see how it will steer through these turbulent times. Section 7. Navigating the path ahead. Predictions and possibilities. Predicting the future direction of financial markets is notoriously difficult. The complexity of global economies, the interplay of various factors, and the unpredictability of human behavior all contribute to this challenge. Financial analysts spend countless hours poring over data, trying to make sense of trends and patterns that might offer a glimpse into the future. However, several factors suggest that volatility is likely to persist in the near term. Market volatility can be both a risk and an opportunity for investors. Understanding the underlying causes of this volatility is crucial for making informed decisions. These include ongoing geopolitical tensions, persistent inflation, and the potential for a global recession. Geopolitical events can have far-reaching impacts on financial markets, often causing sudden and dramatic shifts in investor sentiment. The war in Ukraine has created a high degree of uncertainty in the global economy. The conflict has not only caused human suffering but also disrupted global supply chains, leading to shortages and increased costs for many goods. The conflict has disrupted supply chains, pushed up energy prices, and raised the specter of a broader geopolitical conflict. Energy prices, in particular, have a significant impact on the cost of living and the overall economic stability of countries around the world. These factors are likely to continue to weigh on investor sentiment. When investors are uncertain about the future, they tend to be more cautious, which can lead to reduced market activity and lower stock prices. Inflation remains stubbornly high in many parts of the world. High inflation erodes purchasing power, making it more expensive for consumers to buy goods and services. This is forcing central banks to raise interest rates, which could dampen economic growth. Higher interest rates make borrowing more expensive, which can slow down investment and spending. The longer inflation remains elevated, the greater the risk of a recession. A recession can have severe consequences for employment, income, and overall economic well-being. Despite the current market turmoil, there are also reasons for cautious optimism. Some sectors of the economy continue to perform well, and there are opportunities for growth and investment. The global economy has proven to be remarkably resilient in recent years. Even in the face of significant challenges, many businesses have adapted and thrived. Many companies are still reporting strong earnings, and consumer spending remains robust in many countries. This resilience is a testament to the adaptability and innovation of businesses and consumers alike. The path ahead for financial markets is uncertain. While there are risks, there are also opportunities for those who are prepared to navigate the complexities of the market. However, by carefully analyzing the factors at play and making informed investment decisions, investors can navigate the challenges and capitalize on the opportunities that lie ahead. Staying informed, being adaptable, and having a long-term perspective are key strategies for success in an unpredictable market.